This is Wall Street Week. I'm David Weston, bringing you stories of capitalism. This week, reconciliation. What's needed to make the tough decisions surrounding the national debt? And a look at one of Wall Street's passion assets. We talk with collectors, advisors, and auctioneers about the big business of fine art. But we start with a story about demand, specifically the demand for artificial intelligence. We know it will be big, and that means we're going to need massive computing power from data centers, and lots of them.
When you see the world's leading technology companies who are as close to this as anybody, making the scale of investments that they are, to me that's an extraordinary sign of the potential that they see in the future.
Eric Schwartz is CEO of CyrusOne, one of the largest data center owners and operators in the world. Schwartz is at the forefront of a modern gold rush as big tech companies scramble for the resources to turn electricity into computing power. We wanted to see for ourselves what the building blocks of the AI boom looked like, and so we traveled to Texas, a state with one of the highest numbers of data centers in the United States. In a suburb north of Dallas, we met with Schwartz at one of his firm's new facilities. It spans nearly 1 million square feet. We toured the massive, high-ceiling building filled with row upon row of black cabinets shielding racks of computers from prying eyes, all of which are built a meter or so above ground level to permit an elaborate system to pump cool air up into the computer racks. That explains the high ceilings, which let the warm air rise to be recycled through the cooling system. Schwartz says the race to build data centers like his in Texas is only getting started, with CyrusOne in the process of adding additional buildings and capacity next to its current facilities.
The risk to us as a developer for those customers is to ensure that we can keep up with their demand and that we're delivering both capacity and service at the levels they require. They're all operating mission-critical infrastructure, and their expectations are intensely high. We do our best and are constantly investing to ensure that we can keep up with those expectations. But our real challenge is to make sure that we're keeping up with their requirements because they're counting on this infrastructure to support the growth investments that they're making.
Keeping up with those requirements is not going to be easy. But the good news for the United States is that it has a strong head start. There are more than 7,000 data centers worldwide, with nearly 2,000 in America alone. U.S. data center capacity grew almost a quarter in the last year alone, with another 70% set to come online from centers already under construction today.
The United States is a substantially larger data center market than the other regions around the world, and that's driven in part by the adoption of the internet, by the presence of the large technology companies who are based here, but also by the fact that investment and progress against artificial intelligence here in the United States is further advanced than it is in other regions. And so right now, you'll see much stronger demand and growth in the United States. Other countries around the world are very focused on the implications of artificial intelligence and are concerned about making sure that they have the infrastructure in their economies to keep up. And so we're seeing and will continue to see efforts by other countries around the world to support that type of infrastructure in their countries to support their economies and their growth.
Valdemar Slezak is KKR's global head of digital infrastructure. His firm is making big investments in data centers, including when it teams with global infrastructure partners to buy Eric Schwartz's CyrusOne for $15 billion back in 2022. Like Schwartz, he sees big opportunities coming in Europe and in Asia.
The U.S. is definitely, at least from our perspective, well ahead in terms of the deployment of AI, and I think it is a strategic element of, I think, the growth going forward. If you just think about a couple of maybe examples, cloud companies, U.S. cloud companies have about 75% global market share. In terms of AI funding, 80% of it is coming in the United States. So U.S. is definitely leading the charge, so to speak, in terms of deployment. But I think we see the same similar playbook being applied in Europe and in Asia Pacific. But just to try to quantify the scale of it, U.S. data center market is about a 15 gigawatt market, growing to 40 gigawatts. European market is about 6 gigawatt market, likely going to triple or quadruple over the next 4 or 5 years to 20 gigawatts. And then Asia Pacific, ex-China, is on a similar trajectory. So the scale is really different between US and those other markets.
Meeting that growing demand for data centers will not be easy. There are a host of potential hurdles that people like Christine Wood, head of the data center practice at Burns & McDonnell, are finding ways to overcome.
We're looking at water availability, connectivity, location, demand, latency and then we secondarily look at like the regulations, whether or not they have appropriate zoning requirements, tax incentives, and really if it makes a business sense to be in that specific location. And then once you go into more of the design and construction, what we're starting to see and what we have been doing, especially with our construction arm, is that we really want to get ahead of some of the labor and craft labor shortages that we see out on site. And so we are designing data centers that are more modular, have skid, are able to work within the craft shops of these different self-perform contractors so that we can deploy these data centers more rapidly and on a scalable basis.
But as big as those obstacles may be, the biggest by far is finding the electricity the centers require, with Goldman Sachs estimating that they already consume 1% to 2% of all the power supplied worldwide, and that number could double by the end of the decade.
Power is becoming the long pole in the tent to be able to find a data center site. And so it really starts with that is the power puzzle that we're seeing associated with the data center sites. And so when we're walking through looking for great sites and supporting our clients on the site due diligence side, is we're looking for power as the number one item.
For data centers and their clients, having enough power is necessary, but not sufficient. The power also has to be there without fail and without interruption of any kind.
No excuses. The infrastructure that's operating here needs to be available 24 hours a day, 365 days a year without interruption. So where it starts is that for all of the equipment that we have deployed here, whether it's the battery banks, whether it's the cooling units, all of that, there's always a backup for that equipment in the event that something were to fail. And things always fail, and you need to have a backup to ensure that you don't have an interruption.
That backup at CyrusOne's new Texas facility means layer after layer of redundancy. The facility gets power straight from the grid, but if that fails, batteries located behind the data center kick in. Those batteries are kept fully charged by a series of generators, which are constantly running, and if all else fails, behind the batteries are a row of equally large diesel-powered locomotive engines. If a power outage lasts beyond the life of the batteries, the engines take over to ensure there's nothing to stop the center's operation, including its elaborate cooling system, no matter what the problem. Eric Schwartz says this unprecedented need for reliable power goes beyond just finding out where to get it and how to make sure it's uninterrupted. It also demands an upgrade of the entire way we generate and distribute power in the United States and elsewhere.
So data centers are effectively technology factories, and like any factory, we draw power to operate the factory. And so the challenge and the work that we do is to work very closely with the utilities and the grid operators to identify the right locations where we can connect to that power and ultimately deliver it to our customers. And this requires work, and it requires a lot of collaboration. But the United States in particular, but then other countries as well, are investing in growing their power infrastructure, not only for scale, but for sustainability. And we're very focused on making sure that we're locating in the right places.
Ultimately, what we think is it will require a comprehensive solution. So the technology companies themselves are large consumers of course, this infrastructure, but that's not the only demand driver. It's also onshoring, it's electrification. So there's other, what I would say are great signs of economic progress and growth in the United States, and we should be really proud of that. But it requires a new investment in generation and in transmission, right? It's something that we really haven't seen over the last 20 years. So if you look at the US grid over the last 20 years, effectively stagnated in terms of the demand growth at about 4,100 terawatt hours. What's really interesting, there has been an interesting energy transition during that time. We've decommissioned a lot of coal plants, That's dropped by 65%. We've increased generation from natural gas by about 170%, and increased generation from renewables. And so the grid itself has really gone a very positive transformation. And so what do we think with this level of growth, the expectation is that the demand side of energy will have to go up at a 2 to 3%, which is really different than what the industry had seen over the last 20 years. And so we require new generation to be developed and likely increase investments in the transmission infrastructure to help enable this. And I think from our perspective, we believe that, again, this partnership could really create a powerful solution.
The source of the energy used to power data centers has become a key part of the equation. At a time when the world is trying to wean itself off of fossil fuels, it raises the question of whether meeting the demand will come at the cost of warming the planet even further, something that those commissioning new data centers have very much in mind.
We continue to see our clients have a lot of sustainability goals around renewable and green energy, which is really, really great to see. And so with that, you also want to think about where that capacity is coming from. With renewables, solar and wind come on and off the grid because the sun's not always shining or the wind's not always blowing. And so a lot of times, some of the other power generation plants, especially nuclear, they can't ramp up and down on the grid like solar and wind can. And so you actually have some capacity available at some of these nuclear power plants in order to serve some of these data center customers. And then data centers also are a really good marriage for that nuclear plant because they have a constant load. They have to run 24/7, the servers need to run. And so that nuclear plant can't ramp up and down their reactors like renewables can. And so having that consistent load next to a nuclear plant or tied to a nuclear plant is really an interesting partnership.
To meet their customers' demand, not just for data centers, but for data centers that don't make the climate crisis worse, operators like CyrusOne have set ambitious goals to achieve carbon neutrality despite the ramp up in electricity consumption.
So sustainability has been a focus at CyrusOne for quite some time, and we've already established a target of being carbon neutral by 2030. And that was actually an acceleration of our original plan. So that involves not only working with the grid and the power providers to offset and mitigate any carbon emissions, but also we're working closely with renewable developers to help bring their capacity online and marry that to the demands that we bring. In the longer run, the investments required for the power capacity that's required are substantial.
Does that take us in a direction of self-sustaining in power for data centers? That is to say, they don't need to tap into the grid so much to get power, but they can actually generate themselves.
Right now, the optimal way for us to operate these facilities is to be connected to the grid, and actually we're in a position over time where data centers may actually become a support and a contributor to the grid in times of need. So our strategy and our approach maintains and expects that we'll continue to be connected to the grid as an ability to access those resources, but also over the long term, given the scale of the requirements that we have, the likely and efficient solution to this is much tighter coordination between the utilities, the data center operators, and the grid operators to make the best use of the resources that are deployed.
CyrusOne's customers are demanding that it find more ways to get power from sustainable sources, but the company's owner, KKR, is seeking the same, not just for CyrusOne, but for its infrastructure investments overall. A spike in power demand, what does that mean for the climate? Because at the same time, we were trying to get away from fossil fuels to try to save the climate. How do you put those two together?
We're obviously a huge investor in energy transition, and we're big believers in that. I don't think that those are necessarily mutually exclusive. It's part of a comprehensive solution. So, as I just mentioned, investments in generation, effectively decommissioning coal plants, investments in natural gas plants, those are not only things that help affordability, but also energy security. So we believe, as you know, through our portfolio, we've been a very large investor in renewable. We have 10 renewable platforms across the globe, invested over $34 billion in sustainability since 2010, and we think that's an important part of this solution.
All of this, the demand for data centers, for land, and for enormous amounts of power produced in sustainable ways, presents another sort of demand for capital, a great deal of capital. And that's where we turn next, the need for enormous investment and how global Wall Street is positioning itself to provide it. The story of demand for data centers begins with the physical facilities themselves, finding where to put them, how to provide the reliable power they require, and building an elaborate facility for highly sophisticated equipment that fills them. But the story is also about demand for an enormous supply of capital to pay for those facilities. That demand has led BlackRock and Microsoft to launch a new $30 billion artificial intelligence fund to build data centers and energy projects to support them. Something BlackRock Chairman and CEO Larry Fink pointed toward when he spoke with me after announcing the acquisition of Global Infrastructure Partners, the same firm that teamed up with KKR to buy CyrusOne.
There's a giant need to rebuild and build out infrastructure, whether it is the digital infrastructure as we are all trying to become more engaged with AI and other forms. We have a decarbonization process. More and more countries are more interested than ever before in energy independence. I'm confident we are in the early part of this infrastructure revolution.
Eric Schwartz says the enormous capital this infrastructure transformation requires is a key reason KKR and GIP bought CyrusOne and took it private in the first place.
Public investor audience was concerned about the volumes of capital required and what that might mean for dilution of the publicly traded equity. And so in being taken private with very strong sponsorship and access to deep amounts of capital, we're far better positioned to drive the expansion and investment that's needed to keep up with a very fast-growing industry.
What about the distribution of risk? There's a lot of money that's required to be put in the ground, literally and figuratively, in a data center like this one here in Allen, Texas. At the same time, do you enter into long-term supply contracts with some of your customers so that at least you know there's a stream of income coming in for a good long time?
So our relationships with our customers vary depending on the requirements of the customer and how they intend to structure their own business. But in general, to support the investment that's being made and the ability to access the capital markets, the length of leases for data centers like this one are getting substantially longer, usually 10 years, maybe 15 or even longer. And what that does is gives the customer certainty that they'll have access to the infrastructure because they're making investments here on top of the investments we make. And it gives us the ability to approach the financial markets with a dependable and secure income stream that can be financed to raise the capital that's necessary.
KKR's Valdemar Slezak says confidence in the growth outlook for AI and cloud computing underlies his firm's investment strategy in CyrusOne, in data centers, and in infrastructure more broadly.
I'll just sort of describe it. We have digital infrastructure broadly defined, which captures data centers as one of the three pillars, including mobile infrastructure and fixed line infrastructure, is one of our key themes. So today we have 4 platforms globally in data centers, over 100 facilities, $40 billion of enterprise value across those four data center platforms, and about $110 billion of pipeline of new opportunities that we're evaluating, development opportunities for those data centers.
What is the curve right now for KKR as an investor in data centers? Where'd you start out? How quickly has it grown? Where's it going?
Yeah, I mean, I think that it's more and faster is probably the best way to describe the evolution of data center investments over the last few years. But it's been a progression that I think we've witnessed. If you just step back a little bit and look at what has happened in the industry going back to the 90s, the evolution of internet, sort of I think about it as a 2 gigawatt type of a opportunity. And everything in data centers today is in terms of power, so gigawatts. 2 gigawatt opportunity, then you think about the evolution of cloud and internet 2.0, so sort of an 06 to today, 8 gigawatts. Today, the expectation of Internet 3.0, Cloud 2.0, and AI will be another 25 to 30 gigawatts, but over a much shorter window of time.
Give us a sense of the business model, as it were. I mean, you put the capital in, you fund the building of a data center. How does the revenue come back?
So most of the data center capacity that's built out, it's anchored by a customer contract. So it's a take or pay contract. So typically we would build a facility, which we take some level of development risk on that facility, but it's largely contained since this is an industrial facility in many ways. And then we lease that facility to typically hyperscale customers under a long-term take or pay contract anywhere from 10 to 15 years.
Is there revenue coming in almost from day one?
Yes, there is. I think there's a huge capital investment up front, and there's revenue generation during the contract term, and of course we're also making a bet on the capital appreciation. But it's a core pillar of our infrastructure strategy, looking for these assets that are central to the economy, have a highly visible, predictable cash flow streams, have an inflation protection, and are not necessarily susceptible to economic cycles. So I think it's just a different part of the risk profile and return profile, and it's part of the strategies that we have within KKR.
At the core of that strategy are what those in the industry call hyperscalers, a handful of companies that make up the bulk of the world's cloud computing. The largest names should be familiar: Amazon, Google, Meta, Microsoft, and Oracle. In 2022 alone, those 5 companies invested $158 billion in data centers. Those figures are expected only to grow. And investors like KKR are positioning to catch the wave. Talk about the hyperscalers, as we call them. What is their decision process about whether they just build their own or let somebody like a KKR build one and do a 10 to 15 year contract for it?
They do both. That's the short answer. But I think they're also trying to think about keeping up with their level of growth. So a cloud is a business. 10 years ago, it was a $50 billion business. Today, it's a $500 billion business. Over the next 7 years, expected to quintuple in size. So they're trying to keep up with the level of demand. Furthermore, their core capability is to ultimately develop and sell software. They have a better use for their capital deployment than to lock it up in hard infrastructure. So they're using third parties like us to effectively augment their deployments and to get the operating leverage and the efficiencies from effectively deploying this infrastructure.
The world of data center investment is evolving fast and involves some very big investments being made before we really know where artificial intelligence is taking us. But for big investors like KKR, the real risk is in not keeping up. How confident can you be about that course forward? Because we haven't really seen AI deployed except in some individual applications right now. People are investing an awful lot of money in this. Where could there be sort of detours along the way?
It is a really great question, and I think there are certainly questions on both sides, so to speak, of the aisle. Are we over-investing or under-investing in that? If you listen to certainly the commentary from the hyperscale CEOs, they would say that the risk of under-investment trumps that of over-investment. And I would use an interesting analogy. If you study the prior cycles of technology evolution, whether it's PC, mobile, or cloud, typically Wall Street underestimates the penetration by about 30 to 40%. So if you apply that same sort of analogy here, we're most likely undershooting the ultimate demand need for AI infrastructure. The other interesting point is that the customers here are incredibly well-funded, have very strong balance sheets, and I think are viewing this as a really essential strategy to their business. And so we think that it's ultimately a trend that will continue for the foreseeable future. There's a partner at KKR who says if you don't like evolution, you like obsolescence even less.
Invest in a less than certain future or face possible obsolescence. It's not an easy call. But for those in the middle of the transition, there's one important guide: the explosion in demand for the computing power that drives it all, and for the capital investment to get us there. Still ahead, coming to grips with the realities of the national debt. That's next on Wall Street Week. This is a story about reconciliation, something we may not set out to achieve, something we might even resist as long as we can, but something that most of us end up coming around to in the end. Reconciling with one another today for the sake of what our children need tomorrow. There's no shortage of issues, important issues, for us to disagree about, like whether our economy needs the government to tax less,
cut taxes very substantially, and create a great economy,
or spend more.
First-time home buyers with $25,000
or what we should do about our southern border.
Allowing these millions and millions of people to come into our country and look at what's happening to the towns all over the United States.
We have a broken immigration system and we need to fix it.
Every year in the mountains of Colorado, the Aspen Economic Strategy Group gathers leaders from business, government, and academia to find common ground on important issues like these, seeking to use evidence about the effects of policy to resolve policy differences and to bring us closer to that reconciliation we all need. So we went to Aspen to speak with the group's executive director, Melissa Carney, who said that today, reconciliation faces a unique threat.
What's really interesting and I think challenging is our country is definitely facing a reconsideration of an economic paradigm. And from both parties, we're seeing a move towards more nationalist sentiment, more protectionist sentiment, things that really move away from the market-based economic framework that's driven growth and dynamism for so long. And so the agenda for this year is really based on, all right, let's take this as given. Geopolitical concerns, national security concerns, domestic discontent are driving this reconsideration. And so we're pulling together people who have studied these issues, who have worked on these issues, who have been in government and grappled with these issues for a very long time to try and say, what kind of trade policy should the U.S. pursue? How can we pursue industrial policy in a way that preserves and promotes economic dynamism and economic growth while addressing the very real national security and economic domestic challenges that are driving this reconsideration?
One of the biggest issues in Aspen this year, the federal debt and what can be done about it. Since the early 2000s, the United States has faced an annual budget deficit as the government began spending more than it collected through taxes. That deficit was made worse first by the great financial crisis and then by the COVID-19 pandemic. In both instances, the U.S. government stepped in to rescue the economy, sending the federal debt surging from $9.4 trillion before the great financial crisis to a whopping $35 trillion today. And the debt just keeps on coming, with the Congressional Budget Office expecting it to grow by an additional $2 trillion this year alone. But if there's any good news about the deficit, it could be that its alarming size might force America's leaders to do something about it, even if it means coming together from very different places.
First rule of holes is to stop digging. And you have to, the people who are in those positions of consequence, responsibility, have to understand that they have to govern with a recognition of limits.
Tim Geithner served as Treasury Secretary in President Obama's decidedly Democratic administration. But when it comes to the federal deficit, he's not far away from former Republican House Speaker Kevin McCarthy.
You got to do something with the debt. You can't maintain. Because what we did when COVID had, and you look in just hindsight, we didn't know what was going to happen. So we upped the spending knowing what was coming out. But Congress never pulls it back. You've got some entitlements that are so critical, but you want to sustain those and be able to, so you've got to deal with it now, but you got to do it in a bipartisan manner. Otherwise, one party attacks the other.
Like McCarthy, Tim Geithner sees bipartisanship as the only way to address a problem that's only becoming more complicated with each passing year.
In some ways, it's a much harder challenge because we're going to have to spend more in defense. And because we have an aging population, it's going to be more expensive to give them health care over time. And so we're starting from a very bad place. They're going to have to make some trade-offs. And of course, these are things you can't do on a partisan basis. You know, one of the great strengths of what Hank has built here is, you know, you do get people from different parts of the political spectrum who disagree on fundamental things to come together and sit there and listen to people with deep expertise, to debate hard things, and to try to recreate a place where you can have hard, pragmatic conversations about those tough trade-offs ahead.
The Hank Geithner is talking about is his predecessor as Treasury Secretary, Hank Paulson, who served under President George W. Bush. Paulson agrees with both Geithner and McCarthy that the debt is a big problem, but he also sees a silver lining.
I would say, so I get asked all the time about the economy, and I say, listen, don't ask me about when the Fed's going to cut interest rates or what have you, because we're in a great spot here. But the one thing we know, the big cloud on the horizon, is our federal debt. It's unsustainable, and if not checked, it's ultimately going to destroy our prosperity which is going to undermine our security, which is rooted in our economic strength. And so the way I think about it, if you want to look at the dark cloud, right, on the negative side, that so many of us who have talked about the deficit for so long, it looks like we're crying wolf, right? And so politicians in both parties sort of are ignoring it, right? But the longer we wait, the more expensive it's going to be and the more dangerous it's going to be to clean up this mess before it strangles us. And so again, but that's the bad news. Now, what's the good news? The good news is we're a rich country, right? There's a lot we can do if we start working on it right away. We're going to need both revenues, we're going to need taxes, and we're going to need spending cuts. And people on each side don't like to hear that. But there's plenty of ways we can raise revenues and not impede growth by just closing preferences and loopholes in the tax code. And believe me, you can't deal with this without dealing with entitlements. But you can clearly deal with entitlements through means testing and other mechanisms while protecting those that need it the most. So we can do both.
If Hank Paulson says we can get there, many of us will believe him. He helped lead us out of the great financial crisis, after all. But even if we have a sense of where we need to go, what are the steps between here and there? Paulson says part of the answer is having a Treasury Secretary who has the trust of the president and, ultimately, those on both sides of the aisle.
The number one priority is, first and foremost, develop a relationship of trust with the president. Because Treasury Secretary sounds like it's a very important position, and it is, but all the power really comes to what's delegated by the president, and then the relationships they can build on both sides of the aisle, right? So what you have to do is you have to convince Democrats and Republicans, come up with ways to bring them together. Regulators are independent, but you can have a lot to say if you build relationships. So I think a lot of it, first and foremost, is building that relationship of trust, right? With the president, with both sides, Democrats and Republicans in Congress, and with your colleagues.
Paulson's successor agrees, but says a Treasury Secretary needs to balance working across the aisle with speaking truth to power.
And with markets,
Yep.
and with people around the world that want to believe that they can trust in what you say, and you'll make choices with integrity. But I think Hank's absolutely right. The most important thing is that you have to recognize, you have to be in a position where you are able to say what you think is truth and what is important for the country to do and not to do. And sometimes you have to be the brake and the constraint, and sometimes you have to be the accelerator, the catalyst to try to move a system that's hard to move to better choices.
I've always said you don't want someone as Treasury Secretary who's a politician who wants someday to be president of the United States, right? Because there's a tendency to say what people want to hear, right? And you need to talk about what people need to hear. But you need to have the support of your president to be able to speak that way.
But let's face it, if it were politically easy to fix our problem of rising debt, we would have done it long before now. Kevin McCarthy knows a thing or two about the intersection of politics and policy.
The interesting part about government, you can have the very best idea, but that doesn't mean it passes. So you have to understand policy and politics. And if you don't understand both, you're not going to be successful at either.
And when it comes to the politics of the debt, Kevin McCarthy favors taking a chapter from history, from other times when Congress needed to take big action that was politically fraught.
The way to really tackle it is to look at the way we handled after the Soviet Union collapsed in the 90s, right? We had all these military bases, but a member of Congress is not going to vote to shut it down. So they created what was called a BRAC, a base realignment and closure. So if we create something like this, where all parties get to appoint some, one package has to be able to come out of that committee, no amendments, you vote it up or vote it down. So at the end of the day, that decision will be made on both parties doing it together. Don't criticize each other, but make that decision now. And these big problems that are macro problems, you can't solve them by one party. And our government is not designed where one party rules. You have to have compromise.
In the end, it's not that we need to be reconciled to doing something about the national debt. It's not really about what needs to be done. It's not even about how we could go about it. It comes down to reconciling ourselves to doing something now. If we fail, we're going to have to reconcile ourselves to imposing the problem on the next generation.
Ladies and gentlemen, of course, a warm welcome to our 20th Century and Contemporary Art Evening Sale.
This is a story about investing in our passions. For many, art is a passion, but it's also a big business, one that generated over $65 billion in sales last year. And at the core of that business are people who buy the art, people like Peter Krause.
Remember, these pieces of work, or these assets, if you want to call them that, they don't produce an income. They don't have a coupon associated with them. The only income that you get is the appreciation.
Krause is chairman and CEO of Aperture Investors and has spent a career in finance, including as head of AllianceBernstein. With his wife, he has also become one of the most avid art collectors on Wall Street.
My wife and I have been collecting since we got married, which is 44 years. And the first thing we bought was really sort of a small print. And I said to the gallerist, who's not alive any longer, I said, well, you know what I like, and if you have any more, give me a call. And he looked at me and he said, here's what we're gonna do. If you want to collect art, you will come in every Saturday and I will show you art. But if you think I'm gonna call you on the phone and tell you there's something for you to come and see, that's not happening. And I took his admonition seriously. And my wife and I went in every Saturday. And every Saturday he showed us work, most of which we couldn't afford, but all kinds of paintings. Very little sculpture, but some. And we finally found a painting that we liked and we bought. And it was $6,000. And we paid for it $500 a month until it was paid off.
Over the decades, Krause and his wife Jill have added to that single work, paid for in installments, and assembled a very large collection. It's people like the Krauses who are at the center of a growing web of players, including auction houses, banks, and advisors. They connect one-of-a-kind assets to collectors of all levels, from the very experienced to those just starting out.
A lot of times clients, because art is such a passion for them, it's a pastime. And so they'll let their guard down, which is, wonderful, but at the same time, you don't want to be caught off guard and have a surprise later and buy something that maybe, was overpriced, or you just weren't aware of all of the factors involved.
Fotini Zaitis is head of art finance at Citi, one of the major banks that have added art advisory and financing to their investment offerings. When needed, they lend against the investors' collections to provide the liquidity needed to acquire new art. Zaitis works with Mary Kate O'Hare, who runs Citi's art advisory business.
One of the most important roles of an art advisor is the ability to tell a client no. Because sometimes clients will send us stuff and say, hey, what do you think about this? And it's I think, again, we're always looking out for our clients' best interest. We are, want to make sure they're getting the best they can. So if we don't think it's the right piece, we'll explain the reasons why. Then the client is equipped with the information. They can always make a decision, say, nope, I love it, but then they go into it with eyes wide open.
Doing that can be a challenge in a market that's notoriously opaque. But for buyers like Peter Krause, variety and risk can be both a bug and feature, setting art far apart from the kind of assets he spent his life investing in.
It's not like the stock market where you want to buy a share of Tesla and all the shares of Tesla are exactly the same. Whether it's the first share, the 8th share, the 1 millionth share, it doesn't matter, they're all the same. That's not true for art.
While each work of art is unique, there's a big business in bringing some clarity to the market and in bringing together the buyers and sellers. Enter Edward Dolman.
Well, basically, it's a sort of perfect form of the market. It's the ultimate sort of demand and supply where the two meet, with an auctioneer in front of all our clients who have come along to bid for the works of art that we've offered for sale.
After a 27-year career at Christie's, Edward Dolman became CEO of Phillips, which specializes in contemporary art. Auction houses like Phillips, Sotheby's, and Christie's provide a public forum for price discovery at events throughout the year, including big ones in the spring and the fall.
So the art business is essentially driven by this auction machine, but round it is a huge sort of ecosystem of galleries and collectors and museums and art institutions. So we're a big community, but I do think the auctions are probably at the heart of it.
And we can open up with good interests on the phones, in the room, and online. Good luck to you all at 60,000, 70,000, 80,000 I have with the advanced bidder already.
It's been transformed, actually, in the time that I've been in it, which is a long time now, it's 35 years. When I first started, the market was opaque, to say the least. The only people that had any pricing information were the auctioneers and the dealers who attended the auctions and wrote down all the prices in their catalogues. And I think the biggest transformative event in our world has been information and access to data. So really, the market we see now, what's so different about it is the access to information that everybody has who's in that room competing, whether they're in Asia or South America or Europe or America. They have access to the same information.
Better information is one change in the auction business. Another is the size of the guarantees auction houses are called upon to give sellers, and methods they've developed to help share the risk of those guarantees with would-be buyers.
As the sort of scale of the auctions have got bigger, just in terms of monetary values, it's impossible for the auction houses to take the risk on their own balance sheets. And so, you know, there has been a very sophisticated sort of development of the concept of the irrevocable bid, where an auction house will look and try and find someone who wants to take the risk from you. Someone who actually loves the work of art, is very interested, and wants to buy it at that particular level. A key part of the auction business now is looking for these counterparties and trying to make sure that the risk is spread and is taken off the auction house balance sheet and placed elsewhere.
Who'd like to open the bidding here?
The price may be public, and the seller may be protected by guarantees and irrevocable bids. But for the buyer, the question remains whether a work of art is worth the prices being bid, and also how those prices might be financed, which is where Fotini Zaitis and her colleagues at Citi come in.
At 170 million for the Warhol is selling here to you, sir, at $170 million.
The art market can be still opaque. It has gained transparency in some ways, but in many ways it still remains not a transparent market. A novice collector might need some guidance. So some of the things we look at when evaluating art, be that for an acquisition, a sale, as collateral for an art loan, for insurance purposes, we look at a range of factors. We look at an artist's market history. If it's a more established artist, we look at longevity of that market and what's happening. We look at the individual artwork itself, so the sale history of that work. Oftentimes, or not oftentimes, but sometimes, artworks might show up for sale several times at auction. And what does that tell you? Did it fail to sell? Is it a quote-unquote fresh to the market work for which sometimes there's a premium because that work has been off the market for a number of years, and that creates a lot of kind of excitement when it comes up for sale.
Banks like Citi rely on their assessment of a work's value in making loans to the buyers, a good many loans. According to Deloitte, outstanding borrowing against art could surpass $36 billion this year, up from a projected $29 to $34 billion in 2023. Banks, non-banks, and boutique lenders have increased their lending by 119% over the past 5 years. But these loans are not simply secured by the value of the art being bought. They're made to the purchasers themselves.
As a bank, we offer recourse loans, which is different than asset-based lenders. So the art is definitely, important. And that's why the clients are able to typically live with the art on their walls. So we don't take possession of the art. So clients keep it in their homes. Typically, the art can appreciate in value, and they can take that capital and put it towards other investments, purchase more art, various purposes. But it is primarily based on the client's financial picture. There are asset-based lenders out there for sure that are competing. However, it's a different model, I would say, because in some cases they may have to take possession of the art. Typically, the rates would be higher than what a bank would offer.
As borrowed money becomes a bigger piece of the puzzle, it also means that now, more than ever before, the fortunes of the art industry have become more closely tied with interest rates, which may help explain why overall art market sales were down 4% last year from the year before.
You can actually look at the growth or contractions in our market and get a better understanding of the relationship of art and finance. And I think it reflects a lot of the lending that I was talking about, the sort of explosion in terms of lending against works of art. The interest rates on those loans have become a more and more significant player in our world. So whilst the stock markets have done reasonably well over the last couple of years, the art market has felt a little bit of a decline, and I think that has been driven largely by interest rates and significantly higher levels of interest rates we have now than we had for a long time between 2014 and sort of 2022.
14,900,000.
Today, the art market is larger and more transparent than in the past, and it's interwoven with interest rates and financing and expert advisors. But in the end, whether you're an art investor, a collector, or something of a mix of the two, the value of your purchase depends in part on whether it will resonate through time.
In the media more generally, we follow certain phenomena that rise up, and all of a sudden there's a great deal of interest in a certain artist or a certain form of art, sometimes which goes away. From your experience over quite a few years in this business, can you discern the difference between a fad and a trend?
It's a very good question. I don't think I can. That's the truth.
I think it's impossible. I literally think it's impossible. I think that if you were to ask yourself the question, if you went back to Renaissance times and were in Leonardo da Vinci's studio and he was painting the Mona Lisa, would you have known? Probably hard to tell.
But fortunately, for a true collector like Peter Krause, it's not about predicting where the market will go.
As a collector, the key issue is trying to unlock the language that the artist is using to communicate their feelings or whatever they're putting into the art. And it's trying to figure out that language. That's the mystery to me. And where you figure out that language, then all of a sudden you see what the artist is doing. You may not like it. It may not speak to you. But if it does speak to you, if that language is something you read and it does excite you and it moves you, that's interesting and that's important. And then the question is, are you the only person moved by it? Or are many people moved by it?
We asked Krause if he ever sells from his collection. His one-word answer, never. For the true art collector, as for the true artist, maybe it doesn't matter how many people are moved by a piece. One can be enough. It may be easier for members of the public to discover the prices paid for an artist's work, but that doesn't mean it's easy for them to jump in and start buying. There remain aspects of the art world that outsiders may find difficult. That's where the art advisory business adds value to collectors and to investors.
You know, people find the art world imposing, and I get that. You walk into a gallery and people sort of don't look at you. They sort of assume that, well, you're supposed to know what you're doing. You're supposed to know what the art is. And if you ask a question, they kind of look at you a little bit strangely, like, why did you ask that question? So I think there is a little bit of an aura that's created around art that I don't think is particularly helpful. And it's therefore sort of difficult to start collecting because you feel like you don't know anything, there's nothing to read. How do you get educated? And really the only way to get educated is just go look.
What's the role of art advisors? We hear about them, we read about them, some of us know some of them.
Well, we talked earlier about how do you become comfortable in the art world. And I said that there's really no substitute other than time. But time could be years. It takes a long time. So if you don't want to spend years, and I certainly understand those that don't want to do that, you know, art consultants and art advisors are available and can be very helpful. And they know the world, they know the art world. There's also a challenge in buying work. Sometimes galleries don't sell work to people they don't know. They'll sell work to an advisor who is representing someone they've never sold to. That's another value that advisors provide to collectors who otherwise wouldn't be able to collect that work, that specific work. But I think the challenge with advisors is it's hard for you to develop your own voice. And at the end of the day, you go back to what I said about the language in art. There's an interesting story that happened to us. We were looking at an artist at a gallery, hated the artist, just didn't like it at all. And the gallerist kept saying, "You're missing this. You got to buy this artist. You got to buy this artist." Nope, not buying this artist. Literally 3 shows. And then we walked into the Whitney, who had a show of him and another artist. And we looked at the show, we looked at each other and said, "Oh my God, we blew it." And it was because it was at that moment that it sort of figured out. It's like there was a puzzle in front of you with all the letters jumbled up, and all of a sudden they resolved themselves and you could read the map. And it was crystal clear. And you realized how foolish we had been in not buying that art. And then, of course, we started buying that art at unfortunately much higher prices. But it represents the fact that we got there and we saw it and we developed our view of the language and it spoke to us. And I think when you do that, you have a collection that people will ultimately find unique. There's disparate pieces, but they somehow hang together because there's a language that you read, that you saw, and that's what makes them stick together.
Who are the people who become advisors, and what do they advise on?
Well, they're often ex-auction house employees, people who've been in the market, who understand the market. Quite often they've worked for dealers, big dealerships, because in the time we're talking about, the dealers have transformed their game as well and have become these huge international mega galleries. And so people have come through the auctions, come through these large galleries, and that they then tend to meet 2 or 3 clients in that journey, and then they break off from the auction house or the dealer and specifically work as advisors. So not attempting to transact things that they own or transact things that the auction house they are representing in the auction house. They become someone who is sort of slightly less attached to the actual transaction, that can advise the client on whether this is a good example of a work, a bad example of a work, where the market might be, etc. So that's been a growing community in the art market over the last few years.
Tell us about the art advisory business. What role do you play for the city clients?
So I am head of the art advisory team, and this is a very unique team within all the private banks in that we're a team of art experts. So I myself was a museum curator for a long time before I joined Citi. My other colleagues were art dealers, were independent art advisors, and auction house specialists. And we help clients build art collections. So we act as their private curator. And that can mean helping them buy something, helping them find art, helping them figure out what kind of art they actually like. So we take clients to art fairs, we take them to museums, wherever they're at and whatever they're looking for, we can provide that for them. And we also help clients take care of all the logistics, because something a lot of people don't think about is all the care that an art collection requires. In some ways, they're like a person. They need a doctor every once in a while. They need, they need some TLC. And so we also provide the collections management guidance for that too. So it's really a soup to nuts service for collectors who are looking to build and maintain their collections.
Can you teach someone about art? Because for some of us, art is a little bit intimidating, a little off-putting. Can you teach somebody that, or do they have to learn it themselves?
Well, I think they have to spend a lot of time looking themselves, but that's where we can come in and help direct the looking to make sure that they are looking at for the best quality of work, so that they can really start to create a criteria that helps them understand when an artist was working at their best, or maybe what period that they prefer. Because, of course, artists many of them have very long lives and their styles evolve. And so we'll help guide and provide, opportunities for the clients to get to really know an artist's work or a particular movement. To me, it's one of the most pleasurable parts of my job is being able to take clients to go look at art and have really deep conversations. And a lot of times, you just see like the sparks going off. When you spend a lot of time looking at an artwork, it can come alive in a way. And I think a lot of times in our kind of Instagram culture, and we're just swiping through and looking at pictures, taking that time to really spend time to look at art and speak about it together can really open up all these different avenues of exploration.
Each work of art is unique. Each client is unique. There may be a spark between a piece of art and a client. But how do you know it will spark for someone else as well? Because the value in monetary terms, I suspect, comes from it sparking for other people too.
Yeah, when we're talking to clients, our advisory clients, about what they should collect, the first question is always, what are you responding to? What do you like? And that's a very important question to try to answer. Surprisingly, it can be really hard because, like you say, there's often so much pressure around the art business, and there's a lot of things that are kept unsaid, and you think, I feel silly if I have to ask a question. We say there are no silly questions. Like, every question is valid to ask about an artwork and to talk it through. We'll talk about composition, we'll talk about the history, but we also do talk about the market.
We've talked about your clients. Do they tend to be a single client or a couple or even an entire family that you're dealing with?
It's all of the above. We often work with actually couples more often than not. That can be interesting because sometimes they have very different tastes. And so, you kind of play the middle person in there and try to find things that make everybody happy. Ultimately, I think clients will determine, well, I'll put the things I like here and you'll be able to put them there, and they come to a place like that. But family is a really important part of it, and the art advisory team is part of the family office within the Global Private Bank, and so we think a lot about families. We think a lot about the carryover between generations. I have had the honor of working with a family for many years now who have 2 daughters, and in many ways their collecting has been very much informed by the fact that they have daughters, and so they've been very interested in work by female artists. And over the years, their daughters have gotten very interested in what we do and now come with us to art fairs and have joined us on museum exhibition tours. And so you can see their interest being sparked too. And I think it also is something then the family really shares and enjoys together. So it's really great to see that connectivity and the follow through across the generations.
That does it for us here on Wall Street Week. I'm David Weston. See you next week with more stories of capitalism.